So let's get started. It's going to be a very compact sessions in the next 1.5 sessions. So hopefully you guys can bear with me. One very important thing about this is this fixed income product, or I call this session, is a very complicated. It's actually much more complicated than the equity valuation. So you guys learn at least the first asset class, which is the equities, the stock. This is the second asset class that you're going to learn. This will be a very sophisticated product. And then of course, like the third asset class that you're going to learn will be options, derivatives. That is the hardest one. But you have to understand what's going on with the fixed income first. But before we go into the fixed income, we're going to have some news shared with you. So this is the bond, also another name called fixed income. Fixed income is more for the academic term and the professional term. Bond is just a general name for fixed income. So people talked about bond, but it's actually not just bond, because bond is a longer term, longer maturity securities. If you go after bank deposit, that's also considered a fixed income asset. If you go after a short-term loan, that's also fixed income asset. But a short-term loan is not a bond, so it is a little bit different. But people generalize fixed income asset class as just the bond. So today, well, hopefully today or within these 2 hours, I'm going to cover the debt security. So debt will be a more appropriate word, i.e. fixed income securities. And the one important thing about fixed income is there will be a fixed stream of income that you're going to collect as an investor. So if you invest in equities, if you invest in stock, you may not get any income at all. You may just see the stock price rises and your stock price rises and falls, but you some maybe occasional you get a dividend income, but there is no promise on anything, on any cash flow, any payment from the company to you. Fixed income is different. Fixed income, it is a guarantee, it is a promise, it is a written contract, a legal contract that you sign, or the company sign, and that they promise to pay you a fixed amount of money, and that amount is guaranteed, which means if they fail to pay, then you can file through the legal system, and then you file for the let's say for the bankruptcy and proceed forward, which means it could be a sale of asset. The most famous case nowadays will be Evergrande Hangdamage. So if they are not able to pay any fixed income coupon or the interest expense, then as an investor of the bondholders, then you can actually sue the company and ask the company to sell the asset, pay down the debt. So it's a two different concept. Equities, stock. That's let's say if you are the investor, you will be the shareholder of the company. You are the partners of the company. But then fixed income. If you are the investor of a fixed income, then you are actually lending the money to the company. So you will have a much higher or much senior status than the shareholders. Shareholders may only get, let's say, dividends or even capital gain after the company paid all the liabilities first. So there will be a seniority. If you took commercial law or business law, probably you understand there will be a seniority of claims, and bondholders will always get a proceed before the equity holders. So I just want to make sure that you understand this concept. And of course, we're going to talk about bond markets. I don't want to say like bond markets here, but it's more like a fixed income market, because we don't talk about just one kind of fixed income. Bond is just one kind of fixed income. So make sure you understand the concept. Or you can consider that, but people use fixed income or FI as a more appropriate term. So bond markets, and we're going to talk about the default and credit risk of bond pricing, which incidentally, you guys are very, very lucky because what happened was just barely within like 2 weeks, something major happened in the world, major issue, and I'm not talking about just that happened in Hong Kong. I'm talking about like some global crisis that happened. So some of you probably have heard of SVB, Silicon Valley Bank. Some of you probably heard of Credit Suisse, 汇信, Credit Suisse from Switzerland, and of course, yeah, everything seems like quiet down a little bit in the last couple of days, but it was a perfect storm before. So let's talk about this in a bit. But you guys, the good thing about this course, and the reason I like this particular course is that you can apply a lot of the most recent news, what happened today, what happened now in the world, to the course materials. And I hope with that, you guys will have a better understanding about the concept of what's going on, because you can actually listen to the radio, listen to the watch the television, see the news, and then you will see like what's going on. So let's stop for a little bit. I'm going to talk about this two things. So the first one is to wrap up for the last session, the equity, the stock, the valuation. I occasionally wrote some articles. Oh, actually, it's a weekly articles. So you can click onto it. This is one of them. One way you can actually analyze a sector. So this one is about electric vehicle. So any 动能车, 新能源车. And you can actually check out the articles. It's in Chinese, and the article basically it describes you how you can see the entire sector. You can actually analyze the sector from the demand and supply of some particular components. So you can when you see it, then you see how everything can link up together. So when I was actually preparing this article, it was actually last month. It was back in February. It was around 25th of February. So it was a time when the price was still high. And then once I prepared the article, and then I sent it to my company's in-house media, and then it took them some time to do the editing, and then I sent it to the publisher, and then they wait for a bit, and then at the end they published that like I don't know 2 days ago or yesterday or something like that. But it was actually when this entire sector was down almost 10% before they published that. So it was really late, and I hate that, because it seems like I was doing hindsight, the behavioral finance. But actually I was talking about this like a long time ago, last month, and we even in my portfolio, in my company's portfolio, I shift in the fund, I shift this back in the end of February. So it was lucky, but you can check it out and see how you can analyze a sector from that point of view. Everything is supported by data, very important. And then the second news I want to share with you is is another article I wrote. It's about the interest rate. This one in particular, the second one, the macro analysis, and I'm talking about the SVB situation, how you can link up the entire balance sheet, and how you can analyze a particular bank, because it can be a very serious. So if this is this one is the part not this one right here, and hopefully this is not me, but you see there are two major points here. One of them is the lithium battery price, then the second one is the sales. The sales actually dropped quite a bit. So because sorry. And then this one is about the SVB. They tell you how you can actually calculate the net interest margin. This particular article talked about the SVB bank, and it is about the bank liabilities, and the bank asset and bank liabilities. If you cannot manage that, then that is a problem. And also it talked about the bond situation. So this particular sentence here, because the SVB has some problem with the bond holdings. So this one, if you click here, why it fails, it describes that to you. So when you check this particular failure bank, SVB, so hopefully you guys understand this. When you study investment management, you have to understand what's going on in the world right now. So SVB is like one of the hottest name besides like cryptocurrency right now. So if you guys so let's say if you guys going for an interview in finance area or anything, when you mention something like this SVB, it is better than you mention any cryptocurrency, because crypto is actually outdated. Even if you mention any GPT, that's actually very old news. So SVB is like the news now. But if you let's say if you have interview later on for a summer internship in the next 2 months, SVB will be one of the hottest topic. Try to understand what's going on with it, because it seems like they're having a lot of very conservative holdings, treasuries and agency bond, very conservative. But the problem is when interest rate rises, especially last year for like from 0 to close to 5%, that 5% jump in interest rate is going to kill this particular portfolio, $108 billion portfolio, by almost like 15 to even 20%. So think about this: your liability side will reduce by 20%, but your asset side, as a bank, you have asset, bank deposit, and then the liability side, you lend out the money to others, or you put it in savings. You shrink by 20% here, and people from here withdraw all the monies. There's a problem, because you cannot use this money to cover the withdrawal. So that became the bank run we had a lot we talked about last week. So try to study this news as well. This one is from I can't remember, it's from Bloomberg or from the Financial Times. And then another news which happened a few days ago: First Republic Bank, and also another United States bank, small bank. But one thing I want to point out is the credit rating. Can't remember what that was, but when you click into the article, it's going to be a 2 minute article. So try to read through that. The credit rating agency downgraded this bank, like, I don't know, 3 days ago, 4 days ago, after it fails. Then your question should be like, hey, why didn't you tell me earlier? That is actually very useless in this case. I mean, you only downgrade something to give us a warning when the accident happened already. So that is actually way too slow for the credit agency. Why this is so important? Because first of all, we rely on the credit rating agency to tell us what is the good thing about the bond. You don't have that in stock. You only have analysts recommending the stock, but you don't have any credit rating agency to recommend the stock. Credit rating agency only do something for the fixed income, which is a bond. All kinds of bonds, could be a long-term bond, short-term bond, and sometimes they will do credit rating for a country, but usually they will not do anything for equity. So it's usually for the debt side. But if they only tell us, imagine this credit rating agency is something like an earthquake detector. If the detector tells you only after the earthquake happened, then what's the point? I mean, it's useless. Even if they can have, let's say, a minute or 30 seconds warning before the earthquake, that will be better, right? But this only happened after First Republic Bank stock price dropped over like 50%. Then they give you the downgrade. So that's actually very useless. So you can see, you can check out the news here, and one thing I want you to take care of, especially the first two part was the how to analyze on a sector base, and how the interest rate can actually make a switch. So if you ask, will HSBC have a problem? The money in your bank account, HSBC SCB, or even Bank of China. Bank of China could be different because under the Chinese regulation, those Chinese banks may have an upper limit on the foreign investment. So when they get the deposit from you guys, they may have limited resources and limited values to as to how and how much to invest in the U.S. Treasuries, U.S. bond market. So in that case, that thing may be protected. I mean, the banking sector in China may be protected to some degree. But if you ask, hey, will HSBC have a problem? Yes, definitely. These guys, they definitely will buy U.S. Treasury. No one will skip U.S. Treasuries. In the past 5 years, U.S. Treasuries is the one who is still paying a positive interest rate. If you check the rate from the European side, France, Germany, UK, everything is underwater, which means that you deposit money or you buy the government bond, you need to pay you need to pay back the money to the government. That's actually kind of ridiculous. It's a negative interest rate. It happened, and also it happened in Japan. It has a negative interest rate for a long time because Japan was in the when I was studying at your age, it was the lost 10 years. We call it lost 10 years, but now it is not lost 10 years. It's lost 30 years because in the last 30 years, basically, it didn't have any growth until well, the last prime minister stepped in, who got assassinated recently, half a year ago. But he was the only prime minister who was able to bring up the inflation back to positive zone. What was the name of that prime minister? I can't remember. It seems a long time ago, but yeah, that prime minister who got assassinated bring up the inflation for the first time in decades. So that was the overall picture about what's going on in the world. So you can see no one can avoid investment in the U.S. Treasuries. So every single bank probably will take a hit to some extent, and including not just the banks, but insurance companies, especially insurance companies, because they cannot invest a lot of money in equity area. They can only invest in the fixed income. And if you invest in fixed income, interest rate rises for 5%, boom, you got hit. You got hit definitely by, I don't know, 10, 20, 15%, 10, 15, 20%. That is a must. So all my friends who actually work in the fixed income portfolio as a portfolio manager in the last year, everyone got hit. It is a matter of the degree on how much you got hit. Is it going to be a 10% or is it going to be a 30%? I got some friends actually got wiped out 50% of the portfolio. And as I always use that famous case, one of the most famous wealthiest lady here, not here, but in Hong Kong, actually wiped out the $20 billion Hong Kong dollar portfolio, and she filed bankruptcy. It was a really one. It was actually one became one of the famous news a few weeks ago. Why was it like that? Because first of all, not because of just the interest rate. For the interest rate alone, the portfolio value down by at least like 15 or 20%. But she was holding a lot of Evergrande bonds, supposed to be a very high grade, good quality bond. Now it becomes junk. So I'm going to explain to you what all this is today. So first of all, when we talk about when we focus in this new asset class, this is so fascinating. If I got a chance, let's say 27 years ago, if I got a chance to reshape my career path, if I answer that question differently, because in the first interview with Morgan Stanley, I got asked, do you want to go to the fixed income department or do you want to go to the equity department? It was actually right in the interview. And then I was actually taking like 3 seconds break, but if I should not do that. But that 3 seconds, it actually changed my life. I was actually I was more like an equity guy. I thought I'm equity guy. I like the stock analysis. I like the valuation. I know nothing about bond. I know nothing about fixed income. Of course, I took a fixed income class at university. It's an entire course. So not just 2 sessions, but the entire course. So I studied all the bonds, the notes, and the short-term debts, and then all the overnight repo, repurchase agreement, all these things in one long course. But then when the question asked me, the managing director asked me, hey, Will, do you want a fixed income, join a fixed income department, or do you want to join the equity department? I was so afraid because I don't know that position, is it for fixed income or is it for equities? So I just want to get a job. I just want to get a job. So with my gut feeling, I said, hey, I want to go after equity. And then turns out that the managing director was a fixed income managing director, so it was bad. But he said, hey, I'm a managing director of the fixed income department, so I need to I'll bring you to the other side. I'm not sure they are hiring any. So it was bad for me. But if I choose, if I chose the fixed income side, then my entire career path will be totally different. I probably may not be able to stand here and give you guys this sharing session. But one important thing is for fixed income, the mentality is different, because the whole world, you see, it is not about how to invest $1,000, how to invest $10,000. For fixed income investment, we are talking about $200,000 as a minimum. I'm talking about like wealthy individual investment. Your commission, your earnings will be much bigger, much larger. So in this case, you have a more stable income, you have a more stable fees, and there is no electronic trading in fixed income. Think about this: you can buy, sell equities anytime you want, any place you want, to any particular market. But for fixed income, it is different. The operation for fixed income is different. You have to have connection. You have to know someone in the bank. And for instance, if you know someone from BOC, you can buy some of the Chinese bond, but it doesn't mean that you can actually buy a European bond. But if you open up an account for equities, you can actually buy the US stocks, Hong Kong stocks, or even European stocks. But fixed income is different. You need to have the connection, to do that. So fixed income itself it's a not an entire monster. But the good thing about fixed income is they only have several characteristics. Unlike equities, you have like the many factors going into the equities, but for fixed income, it's different. So bond characteristics, or maybe I should say it's the fixed income characteristics. So first of all, you have to know what is the face value of the bond. Face value, notional value, or par value. That's the same thing. That is the same thing. And always denoted by a very nice number. So it could be $1 million, it could be $1,000, or it could be a notional value. It could be 10,000, 1 million, 1,000. I think the lowest one would be 1,000. It could be 1,000 US dollars, or it could be 1,000 Hong Kong dollars. So nowadays, because people are getting level, it's actually the system, the operation is enhanced by the supercomputer. So we are able to trim down the bond value, the face value into like $2,000. Usually, the bonds or the fixed income that is selling for $1,000 are from the government. So if you check down the Hong Kong government, the I bond, the silver bond, those are denoted $1,000, and it is actually selling. The target market is for the general public. That has a lower face value. But if you are checking out let's say Microsoft, Tesla bond, or 10-cent bond, those are the ones that is actually out of our league. None of us probably sitting here will be able to purchase just even one bond, one contract. Impossible, because the lowest amount will be 200,000 US dollars. Well, maybe some of you can actually do that for several contracts, but for us, for them, this is actually not for the game for general public. It is a game for the wealthiest. It is a game for the insurance company, and it is a game for like the large corporation. So fixed income, when we talked about let's say equity market, we talked about $10 trillion. But in fixed income, we are not talking about $10 trillion. We're talking about like $100 trillion, like a multiple times much bigger than the equity market. So fixed income has this kind of leverage at the exposures. So we have the first thing is the face value. So you understand what a face value or notional value is. And then the second thing is you need to know is the coupon rate. So what interest rate the company promised to give you as a return on a periodic basis. So usually it will be a semi-annual basis, which is half a year, every 6 months. Sometimes some fixed income loan or loan could be a monthly basis. So let's say mortgage loan. When you borrow from the bank on using your mortgage, that means you sign a contract with the bank. Of course, you are the issuer and the bond is the investor. Invest in you, they are the bondholder, and then you sell the mortgage and get the mortgage, right? But you have to pay on a monthly basis. It is not one time, it is a monthly basis. But for corporate or even for the government, it is on a semi-annual basis. And usually they don't have a quarterly basis, but a semi-annual basis or annual basis. So they have to specify the coupon rate. So that is the second thing. Then the third thing is the indenture. But this is actually not the one I was talking about. Actually, what I was going to say is the maturity date. So you have the face value, you have the coupon rates, and also you have the maturity date. That is actually the three most important thing about the fixed income. So you have notional value, maturity date, and also the coupon rate. Why maturity date is important? Because maturity date is one of the filter, one type that actually differentiate between different types of fixed income. Why SVB failed? Went bankrupt because of the maturity. It is not about, it's never about the coupon rate. It is never about coupon rate. It is about the maturity date. What about Evergrande on time of year? Do they fail on the coupon rates or do they fail on the maturity dates? Well, basically they fail on everything. So that is actually too general statement for Evergrande. But for SVB, the latest news, it is about the maturity date because what they hold, majority of them is actually a long duration. And why do you hold a long duration? Because in this particular in these 2 hours, you will learn interest rates is everything. As I told you, time value of money. There are three things that you have to remember in your finance life. The first thing is information. The second thing is interest rate. The third thing is time. With these three powerful elements, you can conquer the whole world. Information, time, interest rate. And trust me, if you have control of three things, you can walk on water. Most important thing about this particular bond is that you have to understand these three terms of notional value, coupon rate, and also the maturity date. So when I talk about maturity date is that the SVB, what happened was the interest rate usually will be when you let's say if you go to a bank for bank deposit, if you deposit for 1 month, your rate is going to be lower. But if you are able to deposit for a longer time, let's say 5 years, then the bank will give you maybe offer a better rates to you. So it will be maybe 5%. So 1% now, maybe 5% for 5 years. So you can see the interest rate is going to have a rising trend if you invest now. Everything is invest now, but then for a longer duration. Why the interest rate is going to go higher in this particular case? Because of the opportunity cost, because of the risk. You can consider as a risk. For 5 years, you don't know what happened, and to compensate for the unknown, for the uncertainty, then they have to give you more, 5%. If everything is just 1%, what does that mean? That means that, hey, this is actually certain. I know 5 years from now, it's going to be 1%, and then now it's also 1%. I know exactly what's going on. Do you think there will be a case of inverted, a downward trend interest rate curve? Yes. And very fortunate, you guys actually see it the first time in the last 10 years. In the last or this half a year or so, our interest rate, except China, the one from China, is actually inverted interest rate curve. It is actually quite rare because the only time you can see an inverted rate is when you have a recession. And why there's an inverted line? Does that mean the future is not risky anymore? No, it means the present is actually more attractive than the future. The future is more unknown to you, and people will not invest in the future. So let's say if you ask, hey, should I invest in 5 years? People say, hey, no, I'm not going to do that. Company will not even invest in it for 5 years because of now. They said, hey, maybe give me some cash now. Cash on hand is better than cash 5 years from now. And because of this, and I will show that to you later on. So the interest rate is very important. How the curve gets up or down. And this is what we called the inverted yield curve. So you guys will probably have heard of that. I think that is the Chinese term, Cantonese term. So hopefully you guys a few things. So bond, very interesting. So you have the maturity, different maturity, 1 to 10 years, 10 to 30 years. That's the U.S. Treasury bonds. The Chinese government also have this. The Hong Kong government, they don't, because the Hong Kong doesn't have a strong basis of investor. So even if they are able to raise the debt, but it is not necessary and it's not useful. So Hong Kong bond market is a very small market. Denominations, that's the face value. It's actually $100, but $1,000 is more common. So why do I have all these gentlemen here? Because there is actually a joke. I still remember that particular moment when I was taking my fixed income class at school. So it was actually at year 3, your age. So the professor asked, hey, there is actually you see there are bonds from different maturities, right? Maturity means the bond will hold it for 1 year, and after 1 year, the issuer, the borrower, will pay you the entire notional amount. So what happened is, think about the cash flow. Very, very important. They give you the coupon interest, right? Periodic basis. So let's say half a year. So first, the 6 months, they give you $100. And then so let's say a bond, it's a 2-year bond, 2-year bond. They give you 6 months, $100 coupon interest. And then after a year, and they give you another $100. And then 1.5 years, they give you another $100. And by the end of the 2 year, they give you $100 for the final coupon payment, coupon interest. And then after that, they'll give you the notional, the entire notional. So let's say if this is a bond for $200,000, they gave you $200,000 back. So what happened is, on the first day, how much are you going to invest? You're going to pay the notional value. Let's say if it is trading at par, then you have to buy $200,000. You pay $200,000, and then done. And then 6 months you collect $100. Another 6 months you collect another $100. 1.5 years, another $100. And at the end of the year 2, you collect $100 plus the notional amount, $200,000. So you're happy, right? In these 2 years, you collect $400 as a return out of the $200,000. Of course, like the rate is low, but hey, if this is really, really secured thing, and it actually happened. It happened back in 2013, where the interest rate is really, really low, going to 0. Then getting $400 out of $200,000 is already something. So think about this. And then during the class, because of the different maturity dates, the professor asked, hey, so which bond will never mature? Which bond that will never mature? There's actually one type of bond that is never mature. And there is actually a girl, one of my classmates, actually raised her hand. Well, she didn't even raise her hand, she just like screamed out. That was a James Bond. So it was a joke. I still remember that particular moment. She said it was James Bond. James Bond never mature. Of course, at that time, 20-something years ago, James Bond never died. I mean, basically never died. So of course, like in the last series of James Bond, he actually died. Well, that's what he said. But anyway, James Bond never died. So I post all these cartoons here. But there is actually one bond that never matures, and that bond is called a perpetuity bond. A perpetuity bond means you pay 100,000. Let's say you pay $1,000, and every single period you're going to get the coupon payment, and forever you're going to get that forever. Would that be a bond price like that? It seems like it's a joke, right? It's a scam, right? It is something that a fraud, a criminal case, right? You pay something, let's say you pay $1,000, but you get only $10 back for every 6 months. No, but in fact, for the price of that perpetuity bond, you don't need to pay $1,000. You probably will pay only like maybe $500 for that perpetuity bond, not exactly the entire notion amount. And in fact, at the very beginning, sometimes you may not need to even pay the notional value. When I said if the bond is trading at par, then you pay the notional value. But if the bond is trading at a discount, then you don't need to pay the notional value. You pay actually a much less if it is trading at a discount. Will a bond trade at a discount? Yes. A bond can trade at premium, a bond can trade at discount. And the price will reflect if this is a premium bond or a discount bond. So there are lots of things that we can talk about, but the three things that you have to be aware of is notional value, coupon rates, maturity dates. That's the three things to differentiate different types of bond. And of course, that will be the fourth one. And the fourth one is the rating, like credit quality. I don't want to say it's a credit rating because credit rating can only apply to some particular bond, but the credit worthiness is the one that you differentiate different bonds. So you can filter, you can screen out the bonds by maturities, short term, long term, medium term, or you can screen out by the notional value, a smaller amount or a bigger amount, or you can screen out by the coupon rate, 2%, 10%, 15%. There are some bonds at 50% coupon rate. And then another thing will be what was that? Maturity. Oh, the credit rating. If you have a better credit rating, a better credit worthiness, then your bond is going to trade closer to the notional value. But if your bond is trading at a discount, it doesn't have the credit worthiness, then your bond is going to trade at a deep discount. And I'm going to show that to you later on. And then of course, like when you have this fixed sort of what might we call fixed income, because it is a fixed income stream for this type of asset. You know exactly when you're going to pay, where you're going to get paid, how much you're going to get paid. So this is this gives investor a lot of confidence. Can equity provide something like this? No. And equity, even Nika Shane or HSBC, they will never ever promise you that they are going to pay any dividends. But for fixed income, it is fixed. It is a promise because it's a liability. It's an obligation for them to pay you. Dividends is not. So I want you guys to differentiate these two different types of assets. Because of this particular characteristics of fixed income, a lot of things can, a lot of derivatives product or a lot of financial engineering can input in this fixed income and generate a lot of like some other products. So what I'm saying is, because of the nature of fixed income, you can think of can you combine all different types of mortgage bond and then package it and then sell it to someone else? Yes, we can actually do that. But before that, let's go over some other extra characteristics for corporate bond. Again, this is corporate bond. Some bond may add on a feature called the callable option, puttable option. So what is callable bond? Callable bond, it means it is not you call the bond. Actually, it is you as an investor. So I assume you guys are investor. So you guys can well, not you guys. You guys can actually, for the puttable bonds. For the puttable bonds, you guys can actually sell the bond back to the issuer if for some reason. So let's say if you want to get a cash, you can actually push the bond back to the borrower and back to the company, and then to exchange for a stock or exchange for the cash. For callable bonds, that is a little bit different. Callable bonds means the company can suddenly say, hey, I don't want to borrow anymore. I'm going to call the bond back. I'm going to give you back the cash. Of course, you guys will think, hey, that's good, right? I mean, you lend the money to someone and someone pay the amount early. That's actually not good. Because when do you think the company will call the bond? The company will call the bond when the interest rate is low, when interest rate hits to zero. In this case, at an interest rate zero environment, what are you going to invest? Where are you going to invest? Then you got stuck with a low interest rate environment, and in that case, you will get lesser return for it. So so think about this. Back in 2019, when the interest rate was at 1%, that was higher. Amazon did something like this. Amazon issued a lot of bonds, and then 2020 COVID hits, interest rate smashed to zero. Amazon immediately called the 4-year bond or 5-year bond back, because when they issued a bond at 1%, and when they issued a bond at 3%, now interest rate that smashed to zero. Then why should they continue to borrow the money at a high interest rate? So they call the bond back. So that's callable bond. And the puttable bond is different, because you guys as an investor will put the bond back, and convertible bonds will give you the options. So you guys, investor, can actually convert the bonds into the equities. And then there will be a floating rate bond. A lot of floating rate bond, most famous case will be the ones in Hong Kong. Inflation protected bond. So it will be a interest rate float compared to the inflation. And of course, like there will be something sort of the subset of the net asset class is called preferred stock. And for preferred stock, it is quasi stock bond, because it is actually right in the middle between the equity and also fixed income. For preferred stock, all the dividends will be accumulated. So in a common stock, the company will not promise you anything. They will not promise you to pay any dividends. But for preferred stock, it is different. Preferred stock will promise you to pay the cash flow stream. But then if they fail to pay, then have to accumulate for next quarter. So you forgot to pay $1, you push that to next quarter and next year, and then you pay another pay that $1 plus the previous $1. So you have to pay $2. The preferred stock, on the other hand, is not an obligation. You are still a shareholder of the company, but not a bondholder. So you can see there's a different claims on the asset in case the company fails. And then, of course, you have, if we expand the scope from one country, there will be international bond, there will be foreign bonds and Euro bonds, and there will be different bonds. So there are a lot of different names. Samurai bonds, bulldog bonds, Euro yen bonds, Euro sterling bonds. Those are the ones that it's denominated in one currency, but then the issue is from another market. The good thing is, instead of memorizing this, well, you don't need to memorize it, but look at the chart here. In China, they call that panda bond. In South Korea, that's kimchi bond. Japan, samurai bond. In Australia, kangaroo bond. In Hong Kong, they call it dim sum bond. Seriously, this is actually how you communicate when you, when you're in the US. You don't say you want to buy the Hong Kong bond. You will say, hey, what about this dim sum bond? What about this panda bond? What about this kangaroo bond? So they know exactly like what that is. So you can check that out. So for dim sum bond, it's issued by the domestic and foreign companies, and the currency is actually Chinese renminbi, not Hong Kong dollars per se. But let's look at the this one. Japan. Foreign company issued in Japan. So think about this. You are a foreign company, but you raise capital in, so let's say you are the US company. You raise the capital in the Japanese market. That's good, right? Why? Because hey, if you went bankrupt, then it's about the people that get hurt. It's not the US people, not your own people, but it's the other people. The same thing here. The panda bond. It is the foreign companies issue a bond in China, but usually the panda bond is it's actually a very small market, because a lot of companies, and as you can see, Tencent, even Evergrande, they will issue a lot of bonds in Singapore Stock Exchange. So that is the overseas, we call it offshore bond. So there is a very lot of colorful name, and there are lots of innovation in the bond market. On the right hand, on the left hand side, I'm not sure you guys are a science major, but I was a science major before. So I learned all this covalent bond. This is from chemistry. Covalent bond, ionic bond, and metallic bond, and how you can combine different elements and make another product. In finance, that is exactly the same thing. You have the three basic elements, right? Par value, notional value, coupon rate, and the duration, the maturity. You have these three things so fixed, so certain. With these three things, then you add on top of that with different features, or even combine different bonds together, and then you can sell it to other people. That is actually very, very genius, very, very smart. So you can create a lot of different products based on this structure. So that's not the thing I want you guys to learn, but as a simple mathematics, again, for bonds, it involves a lot of calculation, mathematics. This one is the inflation adjusted bond. So let's say if you can see the coupon payment here. Try to do that yourself. Why there's $40.80, and how you can make a difference between the payment. Oh, by the way, on that Google Sheets, there is actually a calculation sample. You click into that thing, and you should be able to see. So in calculation examples, you can see the all the calculations. So it's a bond calculation. Oh, it's right here. Right here. So when you have again all the yellow cells here, the input cells, you can put it here. You have put a face value of $1 million, 9.5% coupon interest, and then 5 years of duration. And let's say you are trading at $95. So let's say simplest case, you trade at $100. This is the cash flow that you're going to have. So for a 9.5% semi-annual payment, assume semi-annual, right? Then every period, so 5 years, that means the period is going to be 10 years, right? 10 years. Every 6 months, you are going to pay $47,000. So it's 9.5 divided by 2, right? So $47,000. And in this case, your coupon payment will be this, and then at the end of the year, at the end of the 10th year, at the end of the 5 years, because it's a semi-annual bond. At the end of the 5 years, you can see the issuer has to pay you the $1 million back, plus the last payment of the coupon. And you can see at the end, you will have the coupon payment of $47,000. And when you add all these up, that means it's a $475,000 right here, lower right-hand corner. You can see this is how much you're going to get for 5 years investment. That's 9.5% coupon. And if you want to calculate what is the yield, people talk about the yield. That is quite a different things right here. The yield, it means something. I'll explain to you. The yield is different from the coupon interest. So the coupon rate is 9.5%, right? Coupon rate 9.5. The yield could be different. The yield could be different. Why the yield is different? Because of this particular part here. If at the beginning, if the bond is selling at 95 cents on the dollar, so 95%. So when we talk about, okay, well, maybe I'll take a step away. I'll take a step back. If we are holding an equity value, a stock value, you will say, hey, Tesla is around $450. HSBC is around $53. TVB is around $7. Anyone looked at the news? TVB? I told you guys, I mean, this is like crazy. This is by the way, let me split it another way. TVB, ticker symbol 511, so 5.1.HK. The usual price was around $3.80, so around around $4. By around March, early March, the stock jumped from $4 all the way to $13. It was crazy, and there was only one news, and the news was that Alibaba or Taobao actually is working with TVB on some program, and that's it. People are buying the TVB like crazy. $4 suddenly jumped to $6, $8, and people still keep buying. People doesn't care. How can you explain that situation? Behavioral finance cannot be explained by technical analysis, cannot be explained by fundamental analysis. You can only explain by the behavioral science. The behavioral finance and the behavioral finance saying that I said that, hey, crowd effect. Someone said TVB is good. Let's buy it. Let's buy it. Do I care about the price? No, I don't give a shit. People just keep buying. At $11, people keep still asking me, hey, should I buy TVB? No, fuck no. Hell no. This is like crazy. This is super crazy. I said, no, I'm not going to buy TVB at $8. That was like absolutely crazy because the company is actually losing money. Even they monopolize the entire market, but the company is losing money. Nowadays, no one cares. At least I don't watch TVB. No one cares. So what happened? The stock fall. The stock fall not because of the earnings. Of course, like when the earnings announced, and then stock fall like by 30%. And I think now it's like 40%. So it was crazy. So let me explain to you how that situation works, because I need to show you guys like this crazy. And this is something that I hope you guys will not go out. Oh, today is out. Today is out. It was crazy. It was crazy. Absolutely crazy. So it was trading around like $3.80, and then all the way jumped to like $13. And then after that, all the way now it's like halfway through. A lot of buyers. You can see who is selling, who is buying. There are lots of buyers right here. By the way, there was actually a news, not because of the bad earnings, but there was actually a news. There is a fund called Dodge and Cox, DODGE and Cox, COX. That is actually one of the most famous traditional owned fund house in the US. No one heard of that. I'm pretty sure that whoever wrote the news never heard of that, because I digged into this company long time ago. I digged into this company back in 2006. I still remember that because it was one of the best fund management company with not much publications. But they have a really good fund managers, and the entire thing is really good. Dodge and Cox actually said, hey, they sold a lot of shares on TVB. Of course, I'm going to sell it. I don't care about this crazy market because people are buying with huge volume. This is the right time I should know all my shares. It was, I don't want to say it was a good stock, but let's consider this. If Dodge and Cox actually bought around $20, should they sell it at $13? Yes, I'm going to do that because it is running down to the toilet. You can see like how crazy it is. Back in 2001, it was well, tech boom, and then you can see how that falls and rise. And ever since like 2013, it is done. Why there's a downward trend here? 2013 because the internet boom, a second wave of internet boom. All this 小紅書, all this TikTok, all this high quality programs in China begin to launch, and by that time TVB is actually getting like nowhere, from like $58 all the way to like $3. If you are shareholders around this point, are you going to sell it? Yeah, I'm going to sell it. I'm going to sell the hell out of it. $13. That doesn't have any basis at all. So you can see how the market reacts, and people actually trying to sue the company, saying that, hey, why you claim that you have a bad quarter earnings? That lawsuit is without the merit, and it is going to fail. And it is going to fail nicely. So let's get back to here. For the bond rate. So what happened is the people will sell it at a discount here. And one thing I want to show to you is something like this. So in fixed income, you don't have a lot of information that you can actually check. But Bond Supermart is one website that I recommend you guys to check. The bondsupermart.com, it doesn't include all the bonds, but at least you are able to you're able to see how the bond market works, and you can do a lot of search. So when you do a lot of bond futures, again, you can see it's a maturity year to not, this is not year to maturity, but years to maturity. So duration, coupon rate, and then a bond type. It could be a corporate bond, government bond, high yield bond, and then also the bond currency. So let's see if I want to select the US dollar bond and yield to maturity. I will explain it in a bit. So let's say if I consider 10% plus, and years is going to be, let's say 3 to 5 years, coupon rate low enough, and then bond type corporate. Let's see what it shows. Nothing. Impossible. You see, this is Amazon bond. This is Amazon. Amazon, the first one is AMZN, so you can, it's a short acronym, so AMZN, and then the first number here, 4.25 is the coupon rate, and then the maturity date. So you can see you have the borrower, the coupon rate, the maturity date, right? Notional, they don't usually disclose that, but usually it's around $200,000, $1 million. But people not care about the notional that much, but they care about what that is. This particular feature here is called maturity, or called it. This bond is done. The maturity is 57, so it is a long, really long maturity bond. But then they call back. So let's focus on the one here. Coupon rates. You see the shorter term. It's actually low coupon rate. Why it is a low coupon rate? You can imagine they probably issued this bond back in 2019 or 2018. So 5 years ago when the interest rate is actually low. Why they jumped to 3.8%? Because likely they issued that recently. Do they need the money for Amazon? Well, probably they don't need the money, but this is low interest rate, low enough. Current rate is around 5%. Now it's a 3%, 3.3%. So let's focus on this one. If I click into this bond, you can see you have the bid price, ask price, right? So let's say I remember where I lost myself. when I said the price, right? The stock price, equity price, it is about like, I don't know, $3, $13, right? But in bond prices, in fixed income prices, except there's one particular type, very short term type, overnight, they don't use this. Otherwise, every single fixed income, they will use this 100, they will use 100 as the basis, which means that they will talk about bid-ask price 80, 98. 98, 31, and 62. Usually it's a 31, 62 they would do quote, because people will know that is wrong, slightly lower than 99. This is how they quote. If you switch to another bond, so let's say, if I switch to another bond. So let's say I will do 10-cent US dollar bond. So let's say we pick the one, this one is 24, I will pick 24. 24th December, 25th, I'll pick this one, 3.8. So you can see Amazon and also 10-cent to offer 3.8% coupon rate, right? But look at the price. The bid price ask price 98, 10-cent is also like 97, 98. The bond price is always quoted as a basis of 100. So when we talked about the price of a bond or fixed income, we always use 100 basis. So this is good, right? Because people can use a common language. If you say, hey, HSBC is $53, BOC is around $16. I don't know if this is expensive or not, but if we are talking on the same unit, 97, 91, 97, 92. The other one is 98, 31. Then we know exactly what the price is. So what happened? Same coupon rate, about the same duration. I mean, even though it's one Amazon is actually December, the other one is actually 2 months later, or a little bit more than 1 month later, 6 weeks later. How come the price is so different? Well, first of all, because it's a little bit longer, and actually it matters. In fixed income, every single date counts. Every single date counts. So it is not about just the coupon rates, but it's every single day count. And the second of all is the demand supply drives the price. People will talk about, hey, about the price, the bid price ask price, because it's easy to control, right? But in fact, people talk about this price is actually affected by the yield. I'm not going to say what is the yield to worst. I would just say bid-ask yield. You can see there's a big difference between the bid-ask yield. If you don't understand the bid-ask yield, let me quote another one with you. And if you forget everything, again, you can actually look into this. So let's say I have Evergrande. So let's say we choose the one similar, 24 January. Compare these three bond prices. Oh, let me just hit this really quick. Amazon, 10-cent, and Evergrande. So you can see why Evergrande is going to issue at 12%, because if you don't raise your coupon rates, no one is going to lend you the money. They need the money, right? Demand supply, simple demand supply. You're a risky person. I'm going to ask you to give more, 12%. So you can see from the coupon rate itself, you can see how risky that particular securities is. Can you see from the dividend for stock if this is risky or not? No, you are not able to do that. But in fixed income, all the information is so transparent that you can actually see it. What about the price? The bid-ask price for Evergrande. Is it real? Amazon is 98, 10-cent is 97. Yes, it is 97% of the notional value. If you bring this on and sell it to the market, you're not able to sell it to the issue. You're not able to sell it to 10-cent, but you're able to sell it in the market. Let's say if you bring it to the market, people will buy from you at 97.92. That is the price. So 97.92, it's actually the price. And then of course 97.92% times the notional value, that is the value you're going to do the transaction. Evergrande, $8. What does that mean? This $8, does it really make sense? Bid price, ask price, $8? Yes, it actually makes sense. What happened is, let's say this is 2024 Evergrande bond. $8 means, so assume you can buy from the market. Let's say you pay $9.43. You pay $9 for Evergrande bond. You buy it now. If nothing happened, Evergrande promised to pay everything and return the loan to you by 2024 on January 22nd, end of business day. Your account will be credited by the face value, which is $200,000. Minimum investment quantity. So let's say I buy one contract. I just need to pay. Let's say that won't be $9, but let's say I pay $18. I pay $18, and at the end I will get $200,000. That's nice, right? Yeah, this is really, really nice. You pay $18, and at the end you get $200,000. But still, the market doesn't believe that. It means that you are going to waste that $18. It is a good bet, right? Then I'm going to introduce you the very, very important term, which is considered like not the fourth one, but the fifth. Well, will be the first one. So I said coupon rates, maturity dates, notional value, and then the credit worthiness, right? The four things. But this one will dominate everything, and that is the yield. Because when you look at yield, you see everything. Why would I do that? Hey, when you said you can actually look at the coupon rates to see it, right? Before Evergrande issuing 12% notes, 5 years ago it was actually issuing 4% notes. And if you're still trading at 4% notes, there is no way you can compare how bad the situation is. Can you look at how Tencent the situation, is it good or is it bad because of the maturity date? No. US dollar? No. Coupon rates? No. Well, maybe the company name, you know what's going on. There's no way you can see how good or bad it is. The only information you can see if this is good or not is from the yield. If the yield is low, that means it is very, very safe. So if I said, hey, that would be a really good question. If I said, what do you think? Which one security will have a higher yield? The US Treasuries or the Evergrande security? That is so obvious. Evergrande will have a yield of 1,800%. So what does that yield mean? It means that if you buy the current Evergrande bond now, you will get 1,693% of return by the end of 2024. That is the return, implied return. So you can consider yield as an implied return. This is a very important concept that you need to learn in fixed income. So I may skip a lot of slides going forward, but these are the most important thing you need to know about the fixed income. Coupon rates, notional value, face value, par value, and then the maturity dates, and then the credit worthiness. So the credit situation, which I will disclose, I will tell you in a little bit. But then the yield to yield, this part here can tell you how good or bad it is. And we are going to talk about this yield in the next 4 hours, because we can use yield to evaluate a company. We can use yield to evaluate a stock. The bonds. And even with yield, we can evaluate a country. What is the country's yield for China and for USA or for any emerging market? If I said, hey, the yield can represent everything, do you think Russia will have a high yield or a lower yield? What about Ukraine? What about Argentina? What about China? What about US? What about Japan? Then you probably will have a concept of, hey, is it going to be low or higher or lower? So in the exam, in the quiz, you will probably throw, there will be a question. Yes, it's a qualitative question, but it will be very obvious. So we'll compare the US to Turkey or some other like emerging market, Philippines, some emerging market. Which one will has a high yield if they issue a bond? Then you can say, hey, that definitely will be Philippines because it has a lot of risk investing in the government. Do you trust the government? If I don't trust the government, then it has to be high yield. The same thing as in corporate bond. If you believe in the company, then if the market, not just you, but the market believe in the company, then it will have a much lower yield. But if this is a risky company, then it will be a much higher yield. So if I put this up, or I don't know if, I'm not sure they have. This is actually good. Perpetual corporation. So it's a Credit Suisse perpetual corporation. So that is the perpetuity bond. You can see, and this one is a typical bond, 275. So what do you think the yield of this Credit Suisse bond right now? So we know that the stock price plunged by 40%. It's actually not that bad, but it is 10% worse than Tencent, worse than Amazon. So the yield spiked up and the price actually falls. So you can see. So remember this, bond can trade as equities and the bond price can fall. And when they fall, it will be much faster than you can think of compared to the equity. Okay, let's take a quick break and we'll be back at 10:20, right? And I'll talk to you more about the other stuff. Sorry about this. Here's a good question. I'll answer that question for you. I'll do that in class. That is a good question. I'll do that later. I'll answer that. Yeah. I know what you have mentioned. Yeah. So you guys like bond or you guys like equity? No preference? Bond? Bond or equity? All right, let's get started. I know I talk too much, but a lot of stories to share. Stories to share. I'm going to leave a lot of calculations back to you. So you probably have to understand the logic behind yourself here. So this is more practical. I use a real case to do that. So one of your classmates actually asked a question. Hey, the question was, how come we have let's say if we look at the same company, let's say if we looked at Amazon, sometimes they will issue the bond, the coupon rate at 3.8%. Sometimes they will limit them. So let's say I pull this up and you can see this one. Anyway, so let's say you can see there are different coupon rates here, right? Why there's a different coupon rates for the same company, maybe the different maturity, maybe they were issued on the same dates, but then how come they are different coupon rates? Because when the company, so they take a step back about everything. If you're trying to raise a capital, you're trying to sell something to the market. Let's say you want to complete the deal. You're raising $1 billion. Do you think the market at that particular moment will need or will want to invest in that $1 billion? If there is no market to support that $1 billion, then you have to, how can you attract the market? How can you pull the more investors to come in to buy your bonds? Then you may have to consider a higher rate, maybe from 3.8 going up to 3.9%. So who is going to give advice to you for the higher percentage? And would it be Amazon CFO's team? No, it won't be. Amazon's CFO team will work closely with the banker, the investment bank, who is the lead bank, to raise the money for them. They will know exactly what the market looks like, the target audience, and they will know exactly what the investor wants, how much the investor wants. And they said that, hey, $1 billion at this point probably is too, there are actually too many monies out there. So back in 2016, let's say 2016, when interest rate is like goes zero, if you are able to raise, let's say your coupon rates at 2%, at that point in time, everyone will jump in. If Amazon is like 2%, everyone will jump in. But now, if you said you're raising the debts, raising the bond at 2%, no one will care. Because, hey, I can invest somewhere outside 5%. Why should I even participate in that 2% for you? No way. So in this case, you have to think about the demand supply. Demand supply at that particular moment to determine the coupon rate. So you may see a company may have a different coupon rate situation. And if the coupon rate is not according to the market, i.e. like not extremely suitable for the market, then the market will adjust the price by the yield, which means right here, they will adjust the bid price. He said that, hey, people may not like your bond that much, not because you are bad, no hard feeling, not because you are bad, but they just have a lot of options, a lot of alternatives. Then let's say you may be able to sell at lower price, and if this is lower price, then the yield will get higher. So this is the next concept that I want you to understand: price yield relationship. The higher the price, the lower the yield. The lower the yield, the lower the price, the higher the yield. This is actually inverse relationship. And how and why is it like that? Very simple because of the present value formula. So if you, let's say if we go back to the present value formula, R is the yield. You have one yield to maturity, YTM, which is what we call yield to maturity. You consider yield, the name yield is like a return maturity. So you can see what is your return if you hold Evergrande for 2 years, for 1 year, less than 1 year, you can get about over 1,000% return. That's a yield. That's a return. What if you hold Amazon also for less than 2 years? Then you're going to get only like 4% return total. So that's a 4% return. So you can see there is a relationship between the yield and also the price. Make sure you understand this. So the bond price, the yield, and the coupon. Coupon is fixed, right? This one is fixed. So, these two things right here. So there is a relationship. In this particular class, I will not have time to go into details with you, so I urge you to go into the spreadsheet and try that out yourself. And of course, the best way to do it is to go inside to the formula. So don't just look at the $95,000. Why this is $95,000? It is everything is linked to these cells. Study this, and you will get how I can calculate all these things. How to calculate all these returns. Of course, in the quiz, I'm not going to ask you to generate this table. Do you guys, by the way, do you guys think that ICA2 is hard? It's too hard. Is it hard? Oh, okay. It is not that for anyone to believe this is like too easy. Eva said it's too easy. She said it's easy. But okay, let me ask you this. Did she go over every single question with you beforehand? I specifically asked her to go over every single question. All formulas are given, right? Not really. I know. Sometimes this is actually not on your side, but it's about the cost structure. I talked to the dean already about this, even though it's recorded. But in finance, you have to have a separate course for equities, stock, a separate course for fixed income, a separate course for derivatives. Right now, we have a separate course for derivatives. So if I can't remember what that number was, but some of you guys will take the course next year. The derivatives, the options. If you have that options, why can't you have two more intermediary class, like the not the advanced class, because derivatives is actually so advanced. So you should have equities and fixed income. If we're able to split into fixed income and equities, then I can show you how you can do more calculations like that. It actually is much more useful. Do you think options is useful or derivatives is useful? No, it is really advanced subject, but there's no way I can actually show you more how to do the equity valuation, because if I'm able to do that, then it's going to be useful for your life. And I'm talking about like your life, not just this particular course. So all these things I show you is trying to bridge between the theories and also the real world. I can guarantee you that no one here, no one actually even in Hong Kong University. I was checking with the course, the program over there. The professors there will always teach the theory, so not like this. So I rather to show you something here than doing the calculations. So by the way, the session is recorded, and you can read the script. If I talk too fast, you can actually slow down in the YouTube. I post that on the YouTube. in the exam, you may expect to see something, a screen like this. And then I will ask you some very general information. Is it good or is it bad? Not good or is it good? I need response. If because this is the thing. This is actually the real life. This is not from the textbook. I said I didn't create this bond supermark. But then they have all the information you need. The maturity dates, the notional value, the price of the bond, the bid-ask price, right? The price of the bond, issue dates, and then there's a yield to maturity, and then the issue amount, and then the issue yield. Is it a fixed a bond? This is a standard one. Coupon frequency annually. Senior and secure. This is something I haven't talked about yet. But this is a corporate bond, as you know, and this is in the financial sector. And if you click into the Evergrande, that's a different thing. So this is in the high yield corporate. It's also financials and real estate management and development. And there will be it's a denominator in the US dollar. $200,000 is the minimum. Issue date, maturity date, and the coupon rates, everything is here. And then there will be something like a Standard & Poor's. So there are three rating agencies. One is Standard & Poor's, S&P. The other one is Fitch, and there's a third one called Moody's. Three companies, Moody's. And these are the only three bond rating agencies. So they rate all the bonds in the whole wide world. So if you want to get the market, if you want to get people to buy your bond, then you need to pay this credit rating agencies the fee to evaluate your bond so that you can have a rating. And once with the rating, people will buy it. But then you think, hey, this is BBB. What about if you get a C? Let's say this is your report card. You get a C. Do you think people will not like a C? No. People will like it. Some investors will prefer C. Or even BB. Why do people like BB? BB is actually lower. Why people will like BB? Because I get a higher yield. I get a higher return. I have a higher return, and I don't care. I know the risk that I'm taking, but I prefer the return, and that's why I would select the BBB. So in my portfolio, I may have some fixed income, and usually in the fixed income there will be AAA rating like the U.S. Treasuries, or AA rating Hong Kong bonds, or BBB like this guy. And what do you think I would choose? To me, AAA, single A will be the same, but then BBB, the return will be much higher. I may consider doing some homework with the issuer, with the company, and then I would select the BBB because of a high return. So this is important. If you have something like Evergrande, NR, what does it mean? NR. NR means not rated, withdraw rating. And what does that mean? It means that if you take a bonds, selecting the bonds, this bond will not even come up on your screen. This will not even come on the screen. So as an investor, and you remember, the investors are not individual investors. Investors are usually corporate investors because the incremental is the minimum amount is $200,000. This bond will not even show up on the screen. So it is very important to get credit rating from the Standard & Poor's. So in this case, you trigger a lot of question because hey, a borrower will need to pay the rating agency to evaluate myself. If I pay them more, do you think they will get a higher rating? Maybe yes. So let's say if I'm Evergrande, if I'm He Gayan, Xu Jiaying, what should I do? I should pay $10 million to S&P. Give me a AA rating so I can sell my bond. Do you think that will happen? Of course, it will happen. But a lot of $10 million is actually under the table. That is how corrupted the situation is. Do you think this is actually not not going to happen in the US? No way. It happened in the US for sure. It happened in the US back in 2008. So let me jump back here, and I may have some questions here. So it's recorded, so you can tell your friends, and I even will tell Eva about this this situation. So very basic knowledge. Again, all the slides here is more on the academic base, and a lot of them is actually supported by the calculation. So I urge you to go into this one right here, the calculate, to know understand that the bond payment. And this particular chart, I built this chart, and believe me, I built this. I have this 27 years ago, and I was your age, and I have this because I have no idea how to evaluate different bonds. Because the graph, this is the yield, the price yield graph. On the left-hand side, the y-axis, that's the price of the bond, and on the x-axis, that's the yield. So with the yield to maturity, we call the yield, the return. The higher the yield, the lower the price. That's always the case. And if you see, it is always an inverted curve. But then different bonds will have a different yield here. So this is a problem with SVB, Silicon Valley Bank. Let me explain to you what happened. So let's say they have coupon rates of 10 years, and then there's another bond 6% at 20 years. So if let's look at bond A and bond B. So the blue line and also the red line. So bond A should be this one right here, and the red line. So the blue line, the bond A right here. You can see right here, bond A, and also bond B right here. So let's say when they issue the bond, Silicon Valley Bank at 1%, very low interest rate, 1%. Duration is 20 years. So let's say if they bought a US Treasury, something like this. And then now the bond is becoming this one. Oh, this one actually cannot show you how that is. Okay, maybe I put it this way. So look at here. So let's look at this. Two bonds, right? Bond A and bond B. Bond A has a much longer duration. This is the problem with SVB. They are holding a lot of securities, even though it's in US Treasuries, but they have that in a much longer duration. So that's a bond A, the blue line. If let's say if we are at 2% interest rate bond, so now it's actually before that is 0. If you are going from 0, so let's say this is 2%, 2% jump to 6%, how much bond value you lose? The blue line right here. You are losing from $1,200 all the way to like $950, right? That's $350. But if you are holding a less shorter maturity, you are losing only $50 and you lose $70, the red line. So what happened with SVB was they have this situation. They lost a lot of money in their liability side, and that triggers the entire bank run series, the withdrawal and everything. But do you think this will only impact SVB? 2% to 6%? No, it won't happen just for one bank. It happened for every single bank that have everything that has long maturity. And then you ask, maybe some other banks doesn't have the long maturity. Yeah, that is correct. But think about this. Before they bought this 20 years maturity, every single bank do the same thing. Every single bank do the same thing. Because at that time, the interest rate was low, and if you can offer at 5%, that will be good enough. So that triggers everything. So what I want you to do is try to understand the difference with, let's say, if you type in a 10% coupon rate, 20-year maturity, what will happen with the shape? When we evaluate fixed income, one different thing about compared to equity market is that we all talk about this curve. Which line you prefer? This line or this line, or you prefer, let's say, how come it's all the same? Let's say 5-year, anything. So you can download this file and then you play yourself. So there will be a bond amortization schedule, and then this bond characteristics, and then there is also a bond comparison here, and you will see how the yield and all the different payments can be different. So the model has been built for you, and you can play around with that. And I hope you guys will learn the calculation itself. But in a quiz, probably will not go into that detail because there is no way you can practice that kind of thing. But the relationship is important. Price and yield relationship, PY, the relationship is always inverse. So you got to understand that. So in this case, you will get a one inverted curve, inverse relationship. And then with these graphs, you can actually generate this table by plugging in the table here. So the key question is about the cash flow, the YTM. Again, I explained to you what yield to maturity is, yield, and this yield is the same as the yield right here, 4.8%, 4.7%, and the yield for CS is 12%, and for Evergrande, it's even higher. So you can see the more risk you have, the higher the yield you're going to see. So this is something that you should be aware of. And again, the yield to maturity, you just replace the R with the yield to maturity, and that balance, that particular R, that balance the present value to the future payment. That is the yield to maturity. So what is bond yield? What is yield for fixed income? That is the yield. And current yield is actually the coupon payment divided by its price. So that is the current yield. Again, by its price, not by the notional value. So yield to maturity is the one that you discount all the way back here, but current yield is a different thing. Right now, I don't need you guys to understand what current yield is, but it is a slightly different. If you understand, if you drill down into the formula, that is different. This is the coupon payment, which is fixed, divided by its price. That is the current yield. So this triangular relationship, the bond price and then the yield. And then, of course, if we want to make it more complicated, you add more features into it, and then you will see a plain vanilla bond. So simple traditional bond, that's a straight bond. You will have the blue line. But if this is a callable bond, so the ones issued by Amazon, the callable bond will have a limit, a ceiling for the price. It's capped because, remember this, the lower the interest rate, the more incentive for the company to call back the bond. So in this case, hey, I got a high chance Amazon will pay me earlier, then the price will drop. So it's all about demand supply, about the environment, the investment environment. So again, demand supply is term I always used. And then with the bond yields, I don't need to do this one. So the reinvestment rate. So this is what I was talking about. If you get the $100 of coupon rates, or let's say if Amazon call the bond, you get the money early, then the reinvestment rate will be important, because if the investment rate is decreasing, then your return will drop. You can see if the reinvestment rate is at 10%, this one is at 8%, then your return is going to get a little bit lower. So in this case, if you have a lower interest rate environment, then the return may be lower. But the good thing about a lower interest rate environment is the bond value will get higher, because you can see if the interest rate drop, then the bond price will get high. So what happened with my friends right now in the fixed income? They all hope the 5% rate is going to drop. Well, eventually it's going to drop because I don't know. For this particular year, we may hang in at 5% or even 550 level, and then maybe after like 2023, 2024, the rate will drop because of the potential, the probable recession. And if the rate is going to drop, all these fund portfolio manager will be happy because they will say, hey, my bond price, my bond portfolio price will get higher. So it really depends. So this cartoon was drawn when it was back in 2015, 2016, 2017, when someone issued the China $4 billion bond, lowest ever spreads. People don't care. Forget about the warning sign, the economic warning, property sector. No one cares. Everyone just racing to it. Bond sector has the same problem with the equity sector. If you believe TVB is a problem for those general public, the bond sector is also the same. Otherwise, you won't see a wealthy individual like L09 one will suffer like a bankruptcy of $20 billion bond portfolio, right? So that's something. In bond, we talk about the yield to maturity and the holding period return. It is the same, a very similar concept, as the holding period return. As I said, yield to maturity will be the same thing as here, the 10%. If you hold this until mature, you will get 12% return because they balance out all the future cash flow to the present value. Of course, there will be something called a zero coupon bond. Let's say if a bond, I said there will be always a coupon, right? What if they don't pay you coupon? They just pay you one lump sum, notional amount at the end of the year, at the end of the period. Of course, then the present value of the zero coupon bond will be like close to half. And then, of course, like all these, I assume that you understand the basic concept of yield and also the price. That's the key. And then the longer maturity, the maturity duration thing here. And then, of course, the fourth term, which is the credit rating. Usually, they will be by Moody's, Standard & Poor's, and Fitch Investor Service, 3 rating companies. Do they care? No, they will say, hey, whatever is running the show, they give you the money, then they will give you the rating. So this is the joke that they have. You see this particular guy here wear sunglasses? There's actually implication for that. I hope I can actually show that video clip to you. And for the credit rating, which is the fourth element, right? The fifth element is yield. The fourth element, you have all these credit ratings. So AAA all the way to single A, triple B all the way to single B, and C, triple C. So what is the cutoff for, I call it IG, investment grade, and also the high yield? What is the cutoff? The cutoff is right here, number 7 and number 8. Anything below A minus will consider high yield. Anything above A minus is called IG, so high grade. So triple B will have sort of a step, interest rate discrepancies, some spread over there. So we call the spread SPREAD, spread. So when we talk about fixed income, we always talk about the spread. So you remember the most important thing about fixed income is yield, right? So when we talk about yield, then we talk about what is the yield spread, which means that when we talk about yield spread, we can compare the corporate yield spread, high grade, investment grade, and high yield. What is the spread over there? What is the spread between the US government bond and the Chinese government bond? What is the spread between the 2-year US Treasury and 10-year Treasury? That is important because that is a reflection of a recession. And so we use the yield spread as these. And to evaluate a bond or a fixed income, then we talked about coverage ratios, leverage ratios, liquidity ratios, profitability ratios, cash flow to debt ratios, all these ratios. So with all these combined together, these 3 groups three companies supposed to be independent company, will generate the credit ratings for you, so you can actually search on the database and then to buy the bonds. So you can this is the illustration of what a AAA is and what a B or BA is. So this gives you all these analysis. And then there's actually another evaluation indicator, a ratios called the Altman Z-score. To be honest with you, I never use that, and I don't think the fixed income guys will use that often. But Altman Z is also another indicator, so just like a P ratio. So they will have something like this. And then how they come up with the Altman Z-score is this particular formula. And don't ask me like why it's a 3.1 or 1.0. It is something like that. They calculate that and then they get the Altman Z-score. So you have the Altman Z-score. For this is a screenshot from last year. So you have the Guizhou Mao Tai. You have the Altman Z-score at 34, so which is quite high. Your Tesla on 17. So for the Altman Z-score, anything that is above 2.9 is really good. Anything below 1.2 is a problem. So you can see a lot of, let's say, airlines, ocean, not the Hong Kong Ocean Park, but high chain Ocean Park, some capital, some real estate, networks, computer, software, computer, tourism. All these are within below 1.29. So these will have a negative numbers, and it is really, really bad. So these guys are safe. These guys are bad. With Altman Z-score, you can sort of guess what the quality of the company is. And let's say there are actually some bond indentures. So remember this: for stock, for company, for equities, that is you become a shareholders. There's no contract or whatsoever. You just issue a piece of information that you will be part of the company. But for bond, it is different. Bond is a legal contract. It's an indentures that you the company will have a binding contract and obligations for the company to pay you the debts, pay you back the debts. That is definitely important. So on the contract itself, there will be a lot of terms. There will be a lot of terms to help you as an investor to secure your investment. So let's say they will promise you, they will use a collateral, they will use a sinking fund, they use all the clauses, they even use earnings, promised you before they gave the dividends to shareholders, they have to give the interest payment to you. This is why on the income statement, the interest expense is actually way above the net income before going to the shareholders. Interest payment is the bond payment right in the middle. EBIT, earnings before interest and tax. After EBIT number operating income, that is the interest expense going to the bondholders. So you guys will have the first claim if you buy the asset, if you buy this asset class before, definitely before the equity. So that's the legal contract will be very, very important. So I give you two example that unfortunately I don't have time to do that, but bear with me. One is 10 cents, very, very attractive bond with all the circular. So I want you to hopefully at least you click into it, but it has all the lead bank, Deutsche Bank, and things like that. Important part: corporate structure, credit ratings, risk factors, 40 pages. And then general purpose, what is the covenant, the clauses, like give you the security, give you guys the some comfort. Look at the Evergrande, 50 pages for the risk factors, very important. If you skip that, you miss all the entire part. At that point, it is still low, 8%. Offering circular, guarantees, use of proceeds, corporate structure. I want to show you the corporate structure maybe later, how crazy that company is. And with these two, you can see how you can compare like different bonds. Again, this is not about the company. This is different. The company's different bonds. A company can issue like 10 different bonds, mature and then reissue, refinance, reborrow, and everything. But company stock can only be one. Or they may have another listing in another market, but only one company, one stock. But bonds can be like forever. So bond market is so active. You do the refinancing, rolling, and keep borrowing, and you're paying, you borrow, you're paying, you're borrowing, like Amazon. It's unlimited, very active. But for stock market, it's different. You buy 10 cents, 700, 20 years ago, that will be still 20 years later. You give whatever the price is. So that is the case. I'm going to stop here at 36 at the default risk because this is important, and we'll start from there. And I have several video clip. I want to show that to you. This one is actually good, but maybe next time, next week, slide 36. All right, I will see you guys next time. All right, thank you very much, and hopefully I will see you next week. Oh, by the way, I sent you guys an email. It was last night. I know it's a hurry, but at least some of you showed up. I talked about the market watch. It's just how to do the simulation, simulation portfolio to trading. So nothing important, nothing related to ICA, nothing related to quiz, just pretty much on the trading front. But if you guys, I'll have another quick session about trading next week. Oh, by the way, for the assignment number 2, I will ask Eva to give you guys sort of a preparation talk for assignment number 2, probably next week, some from next week. So you guys will have for every day there will be a 5-10 minutes talk. You guys don't worry. As long as you participate in the simulation program, you will always have materials to write to talk about. First, is about the macro, what's going on in the market. You can talk about inflation, you can talk about SVB, you can talk about like all the crazy Credit Suisse. Second is about your return. What is good, what is bad, what did you learn? That's important. Third one, forecast. What are you going to do with your portfolio? Are you going to sell everything, and why? And why it means not just, hey, randomly say something, but I want you to explain, perhaps in a quantitative way. So this is important. And that's pretty much it. Thank you very much. Again, I will see you guys next week. I said that like 2 times, right?